They have done better than probably any fund manager has done after they shut the fund down while doing almost no work.
Mohnish Pabrai is a wildly successful investor who follows a lot of the value investing principles laid out by Warren Buffett and Charlie Munger. And this year he has been doing a Q&A session every few weeks where he answers questions about his investment strategy. The entire Q&A session goes for about 90 minutes, but in today's video I just want to focus in on one specific part of the Q&A session where he explained what really makes businesses like Costco and Amazon such powerful companies over many decades. He also explains what the specific characteristic is that these kinds of businesses have and how you can identify it in other types of businesses so that you can go out into the world and potentially identify an Amazon or a Costco before they have gone through a significant period of compounding, and as a result you can generate significant returns if you can find and correctly identify those businesses. So that's what we're going to get into in today's video. If you do get some value out of it, I would very much appreciate it if you leave a like on the video, and if you want to see more coverage of this particular Q&A session, then make sure you let me know down in the comment section below. But with that said, let's jump into the video.
They got their 100 million each, they shut down the funds. I would, and what Nick did with the 100 million is he put everything into 3 stocks: Amazon, Costco, and Berkshire Hathaway. And probably Amazon was maybe a third, probably each of them was a third, maybe Amazon may have been a little larger. And at that time, Amazon was maybe around $300 a share. Now it is about $3,300 a share. So for the most part, and then Zach put the money in 6 stocks. So he was a little bit more diversified. But from 2014 till now, Zach has made no changes to the portfolio. It's sitting exactly the way it was. In the case of Nick, when Amazon got to 1,500, he got a little bit concerned about how much concentration he had in Amazon. So he added a 4th stock and cut the Amazon position in half. That 4th stock, ASOS, has also done very well. It's done as well as Amazon. So they have done better than probably any fund manager has done after they shut the fund down while doing almost no work.
Towards the beginning of the Q&A session, Pabrai starts to talk about these 2 investment managers who were able to deliver significantly above average returns over a couple of decades. And he talks specifically about the last 7 years when they closed down their fund and basically told investors to invest in a concentrated group of businesses and that they would be doing the same. And Pabrai was fascinated by their story because when in 2014 they did close their fund and invest in concentrated portfolios that had the likes of Amazon, Costco, and Berkshire Hathaway in their portfolios, because they were able to identify a certain type of business that doesn't come around very often, when they invested in those companies, from that point onward, they had to do very little maintenance on the portfolio. In fact, they didn't touch their portfolio since 2014, and it delivered significant returns. He draws on Amazon as an example, which delivered 11 times their money since 2014. And as I just mentioned, they were able to do this because they found a specific criteria that they had to find in the businesses they invested in, and they were incredibly patient and concentrated their portfolios in the few businesses that demonstrated that specific characteristic.
One of the important things that Nick and Zach figured out was this concept of scaled economy shared. So scaled economy shared is a extremely powerful model. So what happens with most businesses is as they scale, they get operating leverage and the business gets more efficient and the profits increase. So for example, if I take a business like, let's say, MasterCard. So MasterCard basically collects like 20 basis points or 25 basis points on every credit card transaction that is charged to MasterCard anywhere in the world. So that 20-25 basis points comes to them. And of course, their costs are a bunch of servers and a bunch of networks. They don't have much cost. And so as more and more transactions are going through MasterCard, their profitability keeps rising because their costs don't go up with. But what a company like MasterCard does, it keeps the spoils from the scaling. They don't share the scaling profits with the customers. So that is not what Nick is talking about. What he's talking about is enlightened businesses, which as they scale, give the benefits of that scale back to the customer. And there are very, very few businesses that are enlightened enough to do that.
The specific characteristic that these two fund managers were looking for is what's called scaled economies shared. And this is a characteristic that is a competitive advantage. It provides a wide economic moat for businesses that can develop it. And it is extremely rare to find businesses that are able to do this. The foundation of a business that has scale economies shared is, first of all, that they have scale economies or economies of scale. And thereby meaning as the business grows, they're able to gain leverage through becoming more efficient, in that their costs are not rising as fast as their revenue, and their profit margins are improving, and their ability to invest capital at a high percentage, at a high return, is also increasing over time. The example Pabrai uses here is MasterCard. You could also use Visa and many other businesses that I'll talk about a couple more later in this video. But MasterCard, for example, takes a fixed fee first on the number of transactions that they're processing, and then also on the volume of payments. But the actual cost related to the revenue that they're generating is mostly a fixed cost, right? They have these physical servers that actually process payments, but they don't have to build a new server every time they take a new transaction or the volume goes up a little bit. The volume actually has a lot of room to grow where their costs are not growing and their revenue is growing because they're processing more payments, and as a result, their profit margins are always increasing. To be specific, for MasterCard, the net profit margin has improved from 28% in 2011 to 42% in 2020. But what MasterCard does, and this is what most companies do that have an economies of scale, is they take that excess profit that they're generating from becoming more efficient and they deliver it to shareholders. So they're paying higher dividends every year and they're doing more share repurchases every single year. And as a result, they're actually delivering more capital right now to shareholders instead of doing something else with it, which we'll talk about right now. In a business that demonstrates scaled economy shared, not just scale economy, as the business becomes more efficient and they're improving their profit margins, they deliver that excess profit not to shareholders and they don't keep it in the business, but they deliver it to customers in the form of lower prices. And the result of this is that they withhold profit now from shareholders, but they are able to gain and cement a significant market share in the industry, and as a result, allowing the business to thrive consistently over many, many decades. And Pabrai uses Costco as an example of a business that is not only benefiting from economies of scale, becoming more efficient as it grows, but is also delivering those excess profits directly to the customer.
A great business which doesn't exist in India yet, but maybe some of you might be somewhat familiar with, is Costco. And in fact, DMart, Avenue Supermarkets, took a lot of lessons from Costco in their business model. The DMart business model is kind of a combination of Costco and Walmart, which is why nobody can touch them and which is why they do so well. But the Costco model is that Costco, for example, has a rule that any product they sell, the maximum markup that they allow is 15%. So they will not have a markup more than 15% on any product they're selling. And the products are really cheap compared to the other competitors. So for example, Walmart or even Amazon, the typical margin is about 25% or 30%. And so pretty much almost anything you can buy at Walmart or Amazon, if you go to Costco, it will be maybe 10% cheaper. So it's a significant delta. Now, Costco can easily charge more. If they charge more, their profits will go up. But they believe that their lifetime profits will go down. And Costco does not think of itself as a retailer. They think of themselves as a buying agent for their customers. So they charge membership fees. I pay $50 or $75 a year to be a member of Costco to shop there. Pretty much all the 15% margin they take is used to run the business. They don't make any money on that. The only money they make is the membership fee. So that the membership fee is actually what shows up in net income. And so Costco does not think they are in the business of trying to maximize profit. They're in the business of trying to serve their customers.
Costco generates revenue in two key ways. The first is the membership fee that people have to pay in order to go to warehouses and buy products and shop there. And the other way is, of course, the sales that they generate from those products. And like any business that benefits from an economies of scale, as Costco opens more warehouses around the world and is selling products in higher volume, they're of course purchasing products at higher volume, and as a result are able to supply those products at a lower cost to customers. And because of their business model, they pass all of those cost savings on to the customer. And the result of that is that in almost every case, a product that you buy from Costco will be far cheaper, about 10% according to Pabrai's estimation, 10% cheaper than anywhere else, even from Walmart and Amazon. And as a result, that develops a significant competitive advantage in the customer's mind. And even though they're foregoing some profit now because they're taking a smaller markup on products today, they're creating more lifetime profit for the company because they're going to gain more members into their business. So how can you identify businesses that have this kind of advantage? Well, first of all, if they're going to have this advantage, they're going to have two distinct characteristics. The first is that it needs to be a business that can benefit from an economies of scale. And an economies of scale could form because the business has a lot of fixed costs. So something like Adobe, for example, has very, very little variable costs. If they sell more subscriptions, there's really no additional cost to that business, and as a result, they can scale very efficiently and improve their profit margins. Or it could be a business that is benefiting from buying products or buying materials, I should say, in significant bulk. So you have something like an RV company like Thor Industries. Because they are such a massive RV company, they're able to source materials like aluminium in large quantities, and that as a result means lower costs to produce those RVs. And then from that pool of businesses, which is quite a lot of companies, you need to find the very, very few businesses that are passing on those efficient savings to the customer. So what that would look like in the Adobe example, Adobe isn't a business that does this, but what it would look like is as Adobe scales and becomes more profitable because they have very, very little variable costs, they would be passing that on to the customer in the form of having lower subscription fees, far lower than competitors. So it means there's no reason why you would go to anybody else. Adobe has the best software and they're offering the best price. And as a result, they'll forego some profit today, but they'll gain lifetime customers that will deliver significant long-term profits for shareholders. Beyond that specific characteristic, everything else still applies the same in the investment world. So what we're talking about right there is identifying one specific type of competitive advantage or a deep economic moat, but all of the other things need to line up as well. It still needs to be a business that's within your circle of competence, one that you deeply understand so that you can accurately assess the business, the management team, and what the business is worth. It needs to be a company that has consistently demonstrated that they can generate high return on their invested capital. They have to operate with low debt. They have to have a management team that has values aligned with shareholders and has consistently been honest and transparent in their communications with shareholders. And then finally, the stock price has to make sense based on an estimation of future cash flows. So every business is worth the total of the cash flows that business can produce in the future. And businesses that benefit from a scaled economy shared will be able to deliver compounded cash flow growth for many, many decades into the future. So you may be willing to pay a higher multiple on current earnings, but you still need to run a calculation on what cash flows you expect to get out of that business in the future and compare that to the price you pay today. If you want to see me cover more clips from this interview or other interviews from Mohnish Pabrai, then make sure you let me know down in the comment section below. And as I said at the start of the video, if you did get some value out of this, I would very much appreciate it if you take 2 seconds to leave a like on the video and hit that subscribe button if you want to stay up to date with more content in the future. By the way, if you haven't seen my full review on SHARESIGHT, SHARESIGHT is a portfolio tracking software that you can use to track track all of your gains and pull in all of your trades from your brokers automatically and have it track dividend reinvestment plans and currency and stock splits and all of these different things, as well as help you out at tax time when calculating your capital gains and dividend income. I have a full review on SHARESIGHT down. I'll leave it linked down in the description below. And you can also use my link down in the description below for SHARESIGHT to get 4 months of a yearly subscription. So if that's something you're interested in, go check it out. But with that said, hope you guys have a great day, and I'll see you in the next video.